very warm welcome to you all, and thank you so much for joining us. When we first launched RedeConnect, we were in a very different world. We thought we might be finally coming out of the pandemic, and private equity had done quite a good job at navigating through this unprecedented situation. But the start of 2022 has been tumultuous. And I'll just show a couple of slides from our RedeView presentation yesterday. We're all very familiar with everything on this page. And after a long period of insulation, geopolitical and social issues are starting to translate directly into economic effects. And now that we're well into Q2, we're really starting to see the uncertainties of the early part of the year solidify into a core group of challenges for the whole private market asset class, all driven by the macro. So, given this backdrop, we thought it important to add this panel, which is really focused on the latest market developments, and in particular, what this means in terms of investing in the real economy. For a long period now, there seems to have been limited concern from LPs at the multiples being paid for companies, driven, of course, by strong performance of these assets and a general focus on tech. This, however, has changed dramatically in the recent months, and we're starting to see signs of more attention being paid to value-focused strategies and true operational value creation skill across all segments. Tech continues to be a very big and important part of the economy, of course, but other segments that have been more overlooked are now very much back in focus, with LPs looking for those with a skill set and experience to invest well here. So, with that, I am truly grateful to be joined here today by 4 experts in investing in the real economy, and 4 quite different viewpoints given the strategies, the size, and the geographic focus. So first of all, from California, a very warm welcome to Tim Meyer, founding partners of Angeles Equity Partners, a leading manager in the lower mid-market in North America, focused on industrial businesses. Hi, Tim. Then, similarly focused on the lower mid-market, but this time in Italy, welcome to Michele Semenzato, founding partner of Wise Equity, a stellar performer in the European smaller end. Ciao, Michele.
Hi, everyone.
From a special situations perspective, we're joined by Ian Cash, partner of Alchemy, one of the leading special situations managers in Europe. Hi, Ian.
Hi, good afternoon.
And finally, a very warm welcome to Gregorio Napoleone, founding partner at Stirling, a long-standing partner to middle market businesses across all of Europe. Hi, Gregorio.
Hi, Kristina, and thanks for having me here.
So over the next half hour or so, we have a number of topics that we'd like to cover. But please do feel free to send through questions to us using this Q&A function that you can see at the bottom of your window. And then we'll aim to cover as many of these as possible towards the end of this session. So the term real economy is actually fairly new, as I think we're all quite aware. And in many ways, I think it's being used to describe everything non-tech, which is obviously quite broad. So I thought maybe a good starting point to set the scene would be if I could ask each of you what it means to you and how you see your strategy within that. And Ian, I'll kick it over to you to start with.
Thanks, Kristina. So Alchemy is essentially rooted in the old economy. It's really where we've been focused since inception. And at the end of the day, we are value investors. So we're looking to invest cheaply, so buying assets and businesses at a meaningful discount to fair value. That's really what we're about. And we typically invest in businesses with real asset backing, such as freehold leisure assets, such as hotels in Spain, in UK, in Germany, or asset rental like portable toilets in Italy. So we are essentially buying into businesses, decent businesses, but with issues such as over-leveraged capital structures, underinvested assets, poor management, or the wrong strategy. And so whilst we're investing in decent businesses, they've often got issues that need fixing. And of course, in the current environment, which, as you say, Kristina, led by some serious issues on a macroeconomic and geopolitical level, which we think is likely to give rise to a negative impact on economic activity. We're expecting to see an increase in a number of businesses struggling with the wrong cap structure, poorly invested assets, and poor management. So in this type of an environment, we would expect we'd see our strategy catalyzed by those circumstances.
Thank you, Ian. That's very helpful. And Gregorio, maybe I can ask the same thing to you.
I guess we extract the notion of real economy from the contraposition of the new and the old economy. We view the new economy obviously as the high growth tech plays, the digital disruptors that have been creating new markets or dislocating the old ones. And we view the old economy businesses like the rest of the world that has been catching up with this market transformation. We identify the real economy businesses as those that are maybe in the middle, maybe from their original old economy subset that are identifying the opportunity to elevate their performance and accelerate their growth by embracing the elements or most of the elements of the new economy. So in first place, digitalization, to a second degree, sustainability, performance optimization, which is also brought about by the first two. And last but not least, proactive industry consolidation via buy and build M&A. And so these are the real economy champions that Stirling Square is going after and is aiming to support in their ambitious strategies. We have been equipping ourselves for the last 20 years in supporting those real economy champions. We started off from the early days in putting together a team which is pan-European, truly pan-European in their makeup, composition, and heritage. It's 26 people comprising 15 nationalities that operate as local in every single market that we operate. And over time, we have been internalizing capabilities which we believe are crucial to the real economy champions as they take advantage against the old economy peers that are staying behind. And these capabilities are organizational enhancement, they are performance optimization, they are digitalization, sustainability, and proactive buy and build cross-border M&A. In a subset, we try to take local or sub-regional champions and make them regional or intercontinental champions during the holding period of 4, 5 to 6 years. And this has delivered superior performance in the past because the real economy is a structural element of Europe and will stay so for the next few decades. I believe that the past will continue along the future.
Thank you, Gregorio. Tim, is that same definition for you, or how do you see this, and how does that kind of look for Angeles as you think about your strategy?
A lot of similarities for sure with the first two panelists. I interpret the real economy as the tangible assets of the economy, physical capital, labor, and services, businesses that make widgets and their suppliers and labor required for both. That forms the basis of the real economy, and in my opinion, forms the basis of the capital E economy. The term real economy is often simplified by the term industrials, and that's where we focus at Angeles Equity Partners. What we do is in a very simplistic way, transform underperforming industrial businesses. And that level of underperformance could be on one end of the spectrum, sort of a good to great opportunity where you have a good management team, a good business. It's a good time in the cycle, but they're underpacing their potential. That's a light touch deal for us. The other end of the spectrum is a EBITDA negative cash burning business. It may involve a complex carve out from a corporate parent. We're equally comfortable executing on those types of transactions, and frankly, everything in between those two endpoints. For us, there's two primary screens or filters that we use to determine whether or not an industrial business is a good fit with our strategy, and that is complexity, which we trade, and complexity comes in many different forms. We trade complexity for value, and we're not anchored on a particular EBITDA multiple. We're looking to acquire assets that are 2 to 3 times below their comp set. which gives us some room to operate and maneuver. We like to think that we're locking in a return on the buy and giving our operating partners some room to maneuver and drive transformation of those businesses. And the other aspect is clear line of sight to operational value improvement. So complexity and ops value add, if we can convince ourselves of those two screens, it's considered an Angelus deal.
Thank you so much, Tim. And finally, Michele, how do you see this term and how does it apply to WISE?
Well, at WISE Equity, we have always invested in what we call Italian niche leaders, which are typically for us business-to-business manufacturing companies that are very good, sometimes the best in the world at doing something very specific, at serving a very vertical segment. Italy is well known internationally for things like food, fashion, and design in general, but not many people know that it is also the second largest manufacturing economy in Europe, and after Germany, and the industrial footprint that we have here is much more similar to the one inside of Germany than in any other European areas. Example of companies in our portfolio are real world leaders in, for example, T-shaped caps for premium spirits, bicycle components, testing equipment, natural fertilizers, and so on. So for us, investing in the real economy is really continuing to look for these kind of champions. And we believe the supply chain disruptions that we are seeing is probably offering more opportunities to invest in leading Italian manufacturing companies in the future. Again, real economy doesn't mean non-tech for us, as we believe that intensive R&D investment is typically a core aspect for the niche players we support.
Thank you, Michele. And I think that's very useful because I think, again, with these new terms, it's sometimes difficult to kind of imagine what it is we're talking about. But I think that's set the scene very nicely. Tim, as I kind of alluded to, there's obviously a lot going on at the moment, geopolitically and economically. What are the most important elements of the macro that you see as the real drivers of real economy private investments going forward?
Yeah, thanks, Kristina. There are a few, for sure. Just to qualify those few, I would say over the last several decades, the real economy or industrial assets have been defined by low-cost country manufacturing and just-in-time supply chains. And these supply chains are long, inflexible, and very efficient. Emphasis on lower cost, extended terms, and minimal inventory positions. The supply shock caused by COVID-19 and further by the Russia-Ukraine conflict has caused widespread input shortages and supply chain bottlenecks. And so you kind of step back and look at the sort of the macro geopolitical and economic environment, and we think there's a few macro drivers that really define the real economy private investment opportunity. The first is deglobalization, or said differently, regionalization. Second is onshoring, nearshoring. Third, resiliency. I mean, these buzzwords have dominated the headlines as of late. Price and efficiency is no longer as important as resiliency in the face of uncertainty. The other big dynamic that we think is a long-term trend is labor constraints and labor wages. We think this is a big driver that will influence investment opportunities, and certainly industrial automation. As a result of this, industrial automation has never been more interesting as an area to invest. These dynamics will drive investment in new manufacturing, upgrading of existing facilities, and other related investments to bring back aspects of the real economy that were lost to globalization. And this is a by-region dynamic. Further, we believe there'll be a shift away from sole source contracts with fewer large suppliers to more multi-vendor relationships by commodity. An attempt to shift away from efficiency to resiliency and to de-risk the supply chain. Obviously, there'll be winners and losers, and I think certainly It'll be an interesting buying environment for special sits investors. Folks like Alchemy, I think this will create a really interesting buying environment for folks like that. We tend to believe that overall this will benefit lower and middle market businesses. Many will be family and founder-owned businesses. So this broad set of dynamics, we think, will really benefit the lower end of the market. These family and founder-owned businesses will require a sophisticated partner with relevant experience in capital deployment and strategic advice. And we would argue that operational guidance will be more important than it ever has been as you think about building more sophisticated, lower middle market businesses and helping them to scale to support some of these opportunities that might exist for them globally, regionally. And lastly, there'll be opportunities for transformational acquisitions as nascent fragmented industries are formed and the creation of bona fide ESG platforms are established from the ground up. So incredible set of dynamics here. I would argue for private equity in the industrial space, this may represent the most interesting investment horizon we may ever experience, at least in our professional careers.
Thank you, Tim. I think, again, great start for unpicking some of that, and I couldn't agree with you more. Maybe just to start unpicking some of those points, if I can turn to you, Michele, how do you see this? Tim mentioned some of these buzzwords, onshoring, nearshoring. How are you seeing this restructuring of business models, or are you seeing that already, both within the companies that you're looking at and as you're looking at your portfolio?
Well, we certainly see a move toward a change in the supply chain. The supply chain disruption that is deriving first from the pandemic, which has been massive, and now from the war in Ukraine and the Russian sanctions, is affecting pretty much all of our portfolio company and frankly, most of the pipeline, the companies we are looking at. This clearly, we believe is this nearshoring push is first thing going to affect businesses which have a small impact of labor cost, as it is clearly easier to produce in Europe with a highly automatized process. And again, industrial automation, as Tim was saying, will become an important issue. But we are already, frankly, seeing this also in less evident sectors, such as, for example, a push of more made in Italy in the fashion industry. I'll just make a quick example. One of our portfolio companies is the European leader in the production of baseball caps for high-end clients, such as Gucci, Balenciaga, Louis Vuitton. And they produce internally in Italy in a factory near Venice and through external partners based in China. When we invested in 2019, the split of sales was about 40% made in Italy and 60% in China. This year, we are expecting the made in Italy will represent 90% of sales. So in general, we think that for the companies we look at based in Italy, which historically has been a manufacturing hub for Europe, this trend will mean some disruption in the short term. And I don't think we have one company in the portfolio which doesn't have more orders today than the ones they are able to supply. But in the medium and the long term, it's going to be a lot of opportunities for Italian companies.
It's super interesting. Thank you, Michele. Gregorio, maybe passing it on to you. What types of companies and what sectors do you see as the biggest beneficiaries of some of these trends?
Yeah, I'd like to start by touching upon what Tim and Michele just raised. I mean, the supply chain security and the access to resources, whether they be raw materials or labor, have proven to be a challenging aspect across our B2B specialty industrials portfolio. And if we take that as an indicator, I do sympathize. I do share the same view. I think we are going to see a redesign across specialty industrials in Europe of sourcing strategies and sourcing partnerships, but always with a view to de-risking and with a view to risk management. So the biggest word I'd like to kind of raise here, agree with your team fully on operational guidance, but what we have experienced a lot is the necessity to stay close to our senior managers on all kinds of dimensions of risk management. We have faced massive on-time delivery issues related to not just the raw materials, but also absenteeism that initially was COVID-driven, and then when COVID was subsiding, it was still driven by the fear of catching COVID in the factory floor. We are seeing companies that had been relatively relaxed about hedging strategies on raw materials or utilities, and we have seen a massive dislocation in the utility market or even commodities that are being priced for scarcity today. So to me, the biggest lesson learned and the biggest I think proposition for future management in this day and for the near and medium term future is management teams are going to have to be a lot more alert and on their feet and forward thinking in terms of working every single line and subline of the P&L, of the balance sheet, and capital invested in general. And so to me, then going back to your question to me, what type of companies the common denominator I'd like to favor here is companies that are managed by fit for task, if not oversized management teams that are looking at turning every single stone that in the end, if not turned properly, is hurting us today. And companies that, apart from being well managed, rely on robust systems and procedures and have a decent foundation of intellectual property, because intellectual property and pricing power allows you to react, including by repricing your revenues today, and which is always something that we are prompting our managers to do in reaction to this crisis. So I think more than just defining the type of companies by activity or by sector or by country, for me it's all about how champion are they champions, and in terms of sectors, I think business services are bound to remain relatively more resilient, but I agree with Tim. Specialty industrials are the one that are going to be capable of the biggest upswing, if properly managed, if properly guided by us as GPs on their boards.
Thank you, Gregorio. And I think we'll come back to that latest point. But maybe, Ian, I can ask you, you always do a lot of thematic work. What type of thematic work are you doing at the moment, if I may ask, if that's not opening too much of the secret sauce?
Wow, no, not really. I mean, I think we do invest in themes, and we do that kind of two ways. One is we focus on 3 sectors. So we have a sector focus. We've been focused on those sectors now for the last 15 years. And the 3 sectors are hospitality generally, which covers anything from Spanish resort hotels, German business hotels, UK pubs, UK hotels. We look at financial services intensely, and we look at UK house builders. Right? So those sectors have innate characteristics to them which drive a consistent flow of opportunity. And the sort of theme, the underlying investment themes there are, significant fragmentation in terms of ownership, cyclicality, underinvestment, and poor management. And so they ultimately create lots of opportunities on a consistent basis. And of course, there's two big things going on in terms of our opportunity set right now. One is the aftermath of COVID, and of course the sector which has been most impacted by COVID within our sort of thematic focus is hospitality. And so European hospitality is incredibly fragmented, and it's across Europe. So this is very much a pan-European opportunity set. And so we've seen individual owners of assets which have not been invested in properly for 30 years. They're appallingly managed. They offer a very poor product to the customer. And of course, in an environment during COVID, they've not been very nice assets to own. And so we've been able to acquire lots of very good assets which have been poorly invested for the last 25 years very cheaply. We've been able to install better management, we've been able to invest, add rooms and what have you, and essentially create assets which are worth 10 times for 5 times. And during COVID and even today, we're seeing a massive increase in that opportunity set. So we've stood up two new platforms, one in Germany, one in the UK, to continue to do that. So post-COVID, COVID is still having an impact and still driving opportunity. And then the second big area really is, I think that the single biggest issue that is facing or challenging corporate profitability, not just in Europe but everywhere, is inflation. And of course, what inflation does is it has a massive impact on monetary policy and therefore broader economic activity and growth and demand. So it challenges businesses' top line, but it also challenges margins and profitability. And so what we're seeing, I think, emerging now is probably the perfect storm in terms of the challenge to corporate profitability that we haven't seen for maybe 30 years. Central banks haven't had to deal with inflation for 30 years, and they're having to deal with it, and they're behind the curve. And so ultimately what we see is an opportunity, very broad-based, actually, so not just in hospitality, but across a whole range of industries, where cap structures are going to begin to come under pressure, and there'll be opportunities to acquire decent businesses cheaply because of financial distress and dislocation. And so I think there's that broader point. And I think we'll be helped by that because we're going to see volatility in financial markets as well. So hopefully we'll be able to buy good businesses which are in distress from maybe distressed sellers as well. So I know that's a bit of a party pooper, but we really do see a lot of opportunity coming forward over the coming years.
Thanks, Ian. Maybe picking up on that point, I guess already in the last couple of years, we've seen a lot thrown at some of these smaller family-owned businesses. And I guess I'll start with you, Michele, and then probably ask the same to you as well, Gregorio, given your focus. But do you feel the fact that these family-owned businesses, that they've had so much thrown at them, this has opened up more dialogues with these founders and entrepreneurs who now more than ever are looking for help and see the value that you can bring?
Well, yes, we see that. We cannot kid ourselves. We are a majority investor, and as such, we are considered more as a way out for families and founders than a partner for growth. Although it is true that in many cases, we are seen as a good partner for a two-step approach, for a family to sell their business, a way to sell, but to remain involved for a few more years and create some more values together with us. At the end, our strength is to be a credible partner to assure a long-term growth for the company, which is clearly usually a crucial point for the families. But going back to your question, yes, it is true that in a shaky macroeconomic scenario, this situation triggers this kind of opportunity. And we have seen this in the great financial crisis in 2008, where, in the few years after that, a lot of companies came to the market. And this is already happening, and it's likely to happen today. So yes, I would expect the pipeline to increase. And in terms of what we can do for them, I think the best way for us, the way we approach this, the way we approach telling what we can do to help their growth. Typically, we let other people do this part for us. We let them talk to other entrepreneurs and managers, which are the best testimonials of what we have been done together, and let them do the talk. We find this is the most effective way.
Gregorio, are you seeing similar
Absolutely.
things?
Absolutely, echo that. And I think if I can divide the last 20 years, for me, there's probably 3 periods before global financial crisis and the Euro peripheral crisis. It was there was a lot of lack of trust and questioning of the ways and means and the ethics of private equity across continental Europe. Probably out of experience, out of knowledge, and we're talking about entrepreneurs or family companies in the 100 to 500 million range that we serve. That 1-2 sequence of crises acted to dent the confidence of family businesses. All of a sudden, who realized that globalization was a major force, that opportunities were big, but also threats were equal, if not bigger, if not properly addressed. And so we saw an acceleration of private equity activity as becoming the mainstream exit route or succession solution for family-owned businesses. And this is a segment of ours where we still can transact one-to-one with entrepreneurs sitting next to their lawyer. Although intermediation has been rising, you still have this kind of situation. So in that background, it's important to approach sellers with knowledge of their background, knowledge of their sensibilities, aspirations for heritage and future plans for the company, and actually almost kind of craft them for hands with them and carrying them along the way, so that you build trust, you build confidence, and it's not just financial deliverability that will count for them, right? There's a lot of this interpersonal and confidence building. I think the crisis we're going through, started with COVID and now with this yet uncertain development on geopolitical landscape here in Europe, will further exacerbate the sense of vulnerability and the insecurity that many of these entrepreneurs are going to feel. And even more, I would say the recipe for us GPs is to approach these companies, with as many capabilities, as many open minds about how to help transform these companies, how to make their companies champions at a higher level, a different league. And it's not uncommon for these entrepreneurs to sell as a way to de-risk the wealth creation they've made, but also retain a piece. And so in that sense, respect is also part of carrying them along as minority partners, and knowing how to deal with them. And we're very pleased to do so when we have a chance to.
Yeah. Thank you, Gregorio. Tim, maybe back to some of the words that I said at the beginning. We've obviously been living in a world of ever increasing multiples, whilst you've always been anchored in true value. How do you see this now going forward in the current environment?
Well, the rising multiples environment have both LPs and GPs very concerned, particularly tech and healthcare investors. Candidly, selfishly, it has triggered many LPs to pivot and prioritize industrial GPs, where the valuations just seem to make a little bit more sense to a lot of folks. To be fair, industrials is not immune to rising multiples. If you look across tech, healthcare, business services, industrials, over the last 3 years, on average, multiples have increased 2 to 2.5 times. However, industrial assets tend to trade 1.5 to 2 turns below all these other sectors. So on a relative basis, it looks interesting. Valuations seem to make a lot more sense. Again, we're anchored not on, acquiring assets at 5x or 6x. Oftentimes those assets represent a value trap that I think a lot of investors are very concerned about. We're more concerned about making sure we're buying assets 2 to 3 turns below their comp set. And it gives us an opportunity to lock in a gain, if you will, or a return on the front end, and give our operating teams room to maneuver. I think inflation will impact valuations. I think we are concerned about that. I think others are as well. How much, we don't know yet. For us, we attempt to avoid broad banked processes that include a lot of sponsors. This type of dynamic only translates into maximum value for the seller, and that's not where we play. A very successful aspect of our sourcing model is really this concept of thematic investing. It's been touched on by some of the other panelists on this call, but the concept is really driving proactive deal flow around investment opportunities in subsectors where we think we can drive out exceptional returns. And those concepts, those thematic plays, if you will, are developed bottoms up, tops down. It can come from a management presentation that we attend, and we like the space, but we determine this is not the asset to play the space with. And so we'll craft a thesis around the opportunity. We'll syndicate that with bankers that cover the sector. We'll get their input and feedback. That often spikes deal flow. And in some cases, we'll engage a buy-side broker to go find that asset for us. And that's literally finding an asset that fits the profile of exactly what we want to do, oftentimes outside of a bank process, and it becomes a negotiated transaction. Very successful for us. We're about to sign our 10th deal in the current fund, and 6 of those 10 investments have been the result of thematic investing. That's what allowed that style of investing, that sourcing, that execution strategy has allowed us to build a portfolio a little over 6x entry multiple on average across all those assets. It's been a very, very successful strategy for us, and I think it's a nice hedge to this rising multiple environment that we're operating in right now.
Absolutely. And Ian, maybe following on to that, do you think you'll be able to extract further value in this current market? Or for you, is it more business as usual, like Tim was saying, and it's others that needing to adjust their strategies? How do you see that?
Look, I think we'll be very much sticking to our core strategy, built around thematic investing and seeking to find opportunities to access discounted value, right? And we're similar to Tim. We're looking to buy stuff at a discount to fair value, and crucially not get stuck in value traps. It's very easy to find businesses that are trading at 4 times EBITDA when they're probably worth 3 times in 5 years' time. It's a discount to fair value, and the way we access that discount is through really interesting deal dynamics, interesting deal structures, investing in the debt, getting to the equity through a debt restructuring, buying cheaply because assets are dislocated, they're poorly run and poorly invested in. And a very good example of it is a deal we did in the telecom sector, which is actually a pretty highly rated sector, unless of course you're an M&O, which is a lot of capital and very low returns on capital, so very, very bad ROCEs. And so that the M&O space is a not very highly valued sector, but it's a very big sector. But we invested in a pan-European MVNO. There are only 2 of those in Europe, and we managed to essentially buy into that at circa 5 times EBITDA in a sector worth 8 to 10 times, and we're able to access that because we bought the debt, and we bought the debt at 60 cents in the dollar. We then led a debt for equity swap restructuring, which allowed Alchemy to essentially take control of 75% of the entire capital structure, so the post-reorg debt and the post-reorg equity. And the thing is that business needed fixing because it was poorly run. It had the wrong owner, the wrong capital structure. So we've spent the last 2 years, we're kind of 2 years into a 4-year turnaround of that business, which is they're bringing in some of this new technology, so digitalizing the business. So we've taken it from being a retail business and a prepaid business into a digital business with postpaid subscribers, with higher customer lifetime values, with higher margins, and ultimately subscriber growth. And so you've taken actually a decent business with the wrong cap structure. We bought it cheap and instituted and led a digital-led turnaround. So we think there'll be more opportunities. To answer your question directly, we think we will be able to extract further value in this environment because I think the discount on the buy will be greater.
Those are very strong cases for both Angeles and for Alchemy strategies. I think we all know in this industry that dislocation provides challenges, but it's also great investment opportunities for those who know what they're doing. I guess Stirling Square and Wise are not focused on special situations or deep value per se, but equally both of you are very rooted in the real economy and value investors at heart. Maybe Gregorio, I can turn to you first. How do you feel you are best positioned to address the current market and generate great investment returns for your LPs?
Yeah, first of all, we've always been, since inception, a relative value investor. So we've always played our strengths in processes, whether these were relationships with the sell side or the management side, or knowledge advantages, knowledge of the business, knowledge of the sector, any other connecting point that serves the purpose to the transaction. Or situationally, we could actually arbitrage complexity because of the constituent strengths that we have in our team, which on average has a lot of high cross-border experience, including on complex transactions. We've always played these elements, to support pricing discipline and process discipline pre-closing. What we have more recently over the last few years working a lot to improve is the post-closing stewardship discipline. And it has started with embedding capabilities inside the firm that before we were accessing less systematically outside. Now we have internalized them and we have made them part and parcel of our post-closing stewardship program. And then it's about good rigor on the board, working with management, prompting them to turn every stone, and operational guidance, as was said before, but risk management, and keeping the fire in the belly, looking for really every single opportunity to improve further. Not because the business is doing well, we should have reasons to just be happy with that. There's always good opportunities to do more, newer, better. And that's kind of the mindset, the owner's mindset that we as Stirling Square wish to keep and transfer to the younger generations of the deal team as well.
Thank you, Gregorio. Michele, maybe over to you. Sorry, Michele, you're...
So yes, our strategy is to invest in B2B niche leaders with very transformational deals, as it is normal to do when you invest in small companies. They may be very good at their core business, but in many cases lack the managerial skills that are required for a sustainable growth. But we believe that we built the right team to accomplish that, as our track record in 5 funds demonstrate. But I think two features of our strategies will be important in this volatile macroeconomic environment. The first is reasonable entry multiple. Our average entry multiple has historically been, closer to 6x than to 7. It's also between 6 and 7x. But even more than that, low leverage entry. So I think our historical level of leverage is 1.5 to 2x. And that's because given that we are so transformational, we do a lot of add-on acquisition, we do a lot of investments, we don't necessarily need to use that kind of leverage. And that clearly, in my opinion, gives a much stronger return versus risk opportunity to our LPs. So I'm sure the strategies which allowed managers to reach superior returns in these few years in the past through a high use of leverage are likely to become probably less popular in this environment.
Thank you, Michele. So clearly this has been a fascinating discussion. We actually have a number of questions come through. Unfortunately, we're running out of time. So I'll encourage all these questions to follow up with us, and I'm sure we can take these one-on-one with our 4 fantastic panelists on separate occasions. But really, thank you so much for this discussion. It's been really insightful to see how you think about the current backdrop, and how you're going to use your skills to turn it to your advantage. I'd also like to thank you for doing this in what is still very early days, right? And where it's hard for any of us to predict how things will actually change in the months and years to come. So appreciate that you come and give your insights at this stage. What is very clear to me through listening to you all is that private equity is once again going to be able to show its skill set in navigating challenges and turning them into opportunities. The real economy is going to sit at the heart of many of the things that we've discussed here today, probably going through some quite big structural changes. And it's GPs like you that are going to be able to take advantage of this and keep delivering the great returns that you have so far to your LPs. So thank you very much again to all the panelists and to all of you for joining. And please enjoy the rest of RedeConnect. Thank you so much.
Thank you very much.
Thank you.
Bye-bye.
Thank you.
Thank you. Bye-bye.
Bye-bye.